I'm Alayna Johnson, and this is our lecture on money. So today we're going to talk about what is money? Why do pieces of paper have value? How do we determine what that value is? What is inflation? What is deflation? And what does the Federal Reserve do? So we're going to answer all of those questions. But let's start with the first one. What is money? We can start by talking about what purpose it serves, what it does. So there are three things that something must do in order for us to call it money. The first is that it has to be a medium of exchange. The alternative to money for purchasing things would be bartering. So bartering is very inefficient. If you want something from someone, you have to have something that they want, or be able to provide a service that they want. So for example, imagine a world without money. You go to a farmer's market and you want to buy some eggs. So the person selling eggs says that they need soap in exchange for the eggs. Well, you're not a soap maker, so you go to a stall that is selling natural soaps. And the soap seller says that they need apples, and that's what they want for their soaps. So now you have to go to the apple stand, and this goes on and on. And so this is called the dual incidence of wants. In order for bartering to work, it means that I want what you have and you want what I have. So money gives us freedom from that. The second thing that something has to be in order to be called money is a unit of account. So this means that it has to be a uniform unit that we can use to keep track of what's coming in and what's going out, what we're getting, what we're spending. And the last thing that money needs to be is a store of value. So this just means that it will still have value in the future. You can save it, you can lend it, you can borrow it, etc. So all of these things mean that money is also a method of deferred payment. So it can be used to pay debts in the future. So because it's a medium of exchange, this means that everyone will accept it. Because it's a unit of account, you can add up what you owe to be paid later. And because it's a store of value, the money will still be valuable at the time that it's paid back. So anything that can do all of these things can be used as money. So here's some examples of things that have been used as money. Obviously, there's paper money, which is what we use today. This is what's called a fiat currency, which we'll talk more about later. Before we had paper money, natural things like gold and silver were used both as a medium of exchange and as an underlying basis for paper currency later. This one is particularly interesting. These are rye stones. These are used as currency on Yap Island in Micronesia. So they're mined from a nearby island. They have to be mined, carved, and then transported back to Yap. So this is a very time-consuming, difficult process, which really limits the supply of money, which we'll talk more about. And they're mostly used for large transactions because they're not divisible. Sometimes ownership will transfer from one person to another, but the stone won't actually be moved because it's so difficult to do so. So the community just kind of knows what belongs to whom, and there's a record of that. And then the more recent development would be cryptocurrencies like Bitcoin, which are virtual currencies, and these use large amounts of computing power to be mined. So why does money have value? Why do any of these things have value? Why do people accept them as payment for things? So the value of money, just like anything else, comes down to supply and demand. First, demand for money comes down to two things. It's determined by the amount of goods and services available for purchase. So if the money supply were held constant, then more available goods and services would increase the value of money. In other words, the more things that I can buy with my money, the more desirable that money is to me. So if I couldn't buy anything with my money except, say, groceries, then it wouldn't be of much use to me beyond what I need to keep myself fed. The other thing that impacts demand for money is public faith that the money will hold its value over time. So remember from our supply and demand fundamentals that we've learned earlier, one thing that impacts demand and price for anything is expectations about the future. So if my money is going to be worth less in the future than it is right now, then I'm less likely to accept it in exchange for my goods and services. I don't want it. I don't want to keep it. So what impacts the supply of money? Now, this depends on the type of money. The supply of gold, for example, is determined by how much gold there is on Earth and how much of it we can mine. Different cryptocurrencies supply are determined differently, with the supply of Bitcoin being determined by how much is mined. And there's also a maximum cap of the number of Bitcoin that can ever exist. While other cryptocurrencies, which are called stable coins, are pegged to something else, like gold or another currency, which makes them operate in similar ways to a pegged fiat currency. But the supply of paper money is determined by how much the government decides to print. For us in the US, that would be the Federal Reserve who's making that decision. It's also impacted by how fast the money circulates in the economy, which is called the velocity of money. The government can impact velocity of money in some ways, which we'll talk more about later, but this part is mostly out of the government's control, unlike printing. So you can think of velocity of money at its most basic level as how quickly money moves from person to person. So for example, say you buy a latte in the morning, you tip the barista a $5 bill. The barista then goes to see a local band that night when they get off of work. They pay the cover charge with that same $5 bill. Maybe a band member then spends it on a drink after the show, and the same $5 bill has now been exchanged 3 times already. So if the barista had pocketed that $5 and not gone out that night, it would have only been exchanged once. So why does this impact supply? Because if the $5 bill stays in the barista's pocket, it's no longer in circulation, at least temporarily. So how do we measure the money supply? First, we look at how much money is out there in circulation. And then we break it down by how quickly that money will circulate or how liquid it is. Liquidity in this context just means how easy is it to spend this money? So M0, this is cash in circulation. It is the easiest to spend. It is extremely liquid. Then we have MB. So MB is M0, so cash in circulation, plus all the cash that is in bank vaults, as well as Federal Reserve Bank credits. Next, we have M1, which is M0 plus MB plus money that is currently sitting in people's checking accounts. So this is money that you spend by using your debit card or writing a check, right? Or you could even go to the ATM, take out the cash. Now it's cash in circulation. M2, the last step, is M1 plus money in savings accounts, certificates of deposit, which are just deposits in a bank where you're basically agreeing to leave the money in the bank for a certain period of time, and then money market funds. So anything beyond this is not really considered part of the money supply. So things like stocks, bonds, etc., these are considered financial assets, not money supply. So now that we understand how supply and demand works in the context of money, let's talk about how we got from using actual gold, followed by gold-backed currency, to what we have today. So first we have to explain what the gold standard was and how it worked. So with the gold standard, the government owns a certain amount of gold. So printed currency is then worth a specified amount of gold. So the government needed to have enough gold to honor all of the printed currency because at any given time, you could literally go and ask for gold in exchange for your money. So this system only works if the government has the amount of gold necessary to do this, and that people have faith that the government can and will honor the exchange. This system contributed to the wave of globalization that took place in the late 1800s because more and more countries were issuing currencies under the gold standard, which made international exchange much easier. But in a gold standard system, the money supply is constrained by the amount of gold being mined. A government can only print as much money as they have corresponding gold. So this is where we start running into problems, and we'll get more into what those problems might be a little later. Before we do that, we need to have some understanding of inflation and deflation. So what are they, what causes them, and what are their effects? Inflation means a decrease in the value of money over time. Essentially, your purchasing power as a consumer goes down. So what used to be enough money for, say, a dozen eggs will now only get you half a dozen eggs. So this means that inflation is good for you if you have debt. So say you took out student loans, for example, enough for 4 years of tuition. Now, with inflation, the value of money decreases. So by the time you pay it back, that same amount of money might only be worth 2 years of tuition if you were starting now. However, it's bad for you if you have savings. So if you put money into a savings account early in your career, then when you go to withdraw from it in retirement, it's not worth as much as it used to be. So your purchasing power has gone down. Deflation means an increase in the value of money over time. This is the opposite. So this is bad for you if you have debt because your debt is now worth more than it was when you took the loan out. But it's good for you if you have savings because your value has gone up. So when we have a pretty good idea of what inflation will be in the future, it makes lending easier because banks have a good idea of what the money is going to be worth, and they're able to attach an interest rate accordingly. So banks and consumers need to be pretty confident in the value of currency over time in order to enter into these long-term loan agreements, like mortgages, for example. So one of the goals of central banks, like the US Federal Reserve in the United States, is to keep inflation low, stable, and predictable. This is partially because of what we just said about long-term contracts and lending, but it's also because if money is decreasing in value over time, then it's not a good store of value. So this encourages people to spend or invest their money rather than hold on to it. So when inflation gets too high, people don't want to hold on to currency. They want to hold on to things that they're confident will hold their value. So for example, as the economy has been more unpredictable over the past few years, we've seen this increased interest in collectibles because people are more confident that something like a Babe Ruth baseball card, for example, will hold its value over time than will the US dollar. Now, this is especially true in cases of hyperinflation and currency instability. So in countries where hyperinflation has caused people to lose significant value in their savings, people are less likely to hold onto that currency and more likely to use it to purchase physical things that will maintain their value. Deflation, on the other hand, would lead people to save and hoard their money because they know it's going to be worth more later. So why would you spend your money now if you can wait a month or a year and it will be worth more than it is right now? Why would you make a risky investment where you could lose money instead of just putting your money in a savings account and leaving it there because it's going to go up in value no matter what? So this is why central banks are aiming for low and stable inflation. In the US, the inflation goal is typically 2 to 3% inflation per year. They want just enough inflation to encourage people to spend their money, but not so much that it will cause hardship and panic. And in some sense, stability is possibly even more important than low for the Federal Reserve when it comes to inflation, because stable means predictable, which is important for investments, like we talked about, which leads to economic growth, which is what we want, right? So the Federal Reserve has what's called a dual mandate. They manage both the unemployment rate and the inflation rate. So their goals are to keep inflation at 2 to 3% a year, like we said, and also to keep unemployment as low as possible, which we would say is probably somewhere below 4% unemployment. Now, for a long time, those two things were seen as being opposed to each other. The data showed that when inflation was high, unemployment tended to be low. People are spending money, so they're investing, they're hiring, etc. But when inflation is lower, people are holding on to their money. So they're not investing, they're not hiring, and unemployment would rise. And this phenomenon was represented with what we call the Phillips curve. But in recent years, this pattern has not reliably held true. So it's not as useful to understanding the Federal Reserve's present day policy decisions, but it does help explain past decisions by the Federal Reserve, and it helps us understand the history there. So going back to inflation and deflation, what causes these phenomena? So deflation, we know that's when the value of money increases over time. Deflation happens when the supply of money expands more slowly than the supply of goods and services. So if you picture a supply and demand curve and imagine demand increasing, but supply stays the same, and that results in a price increase. In this case, that would be the price of money or the value of money. So this was one of the problems with the gold standard, was that supply can only expand at the rate that new gold is found and or mined. So in 1896, the US was in a period of deflation after the economy had just expanded rapidly. And that year at the Democratic Convention, the nominee, his name was William Jennings Bryan, made a speech advocating for what's called bimetallism, which is using both gold and silver to back currency. He wanted this because he wanted to expand the US money supply to help ease the deflation that had been resulting. This deflation was hitting farmers particularly hard because they often took on debt in the spring and paid it back after harvest season. So if you remember when we talked about deflation as being bad for people in debt, this is a real life example of that. So in his speech, speaking to those who were in favor of the gold standard, Jennings Bryan said, "You shall not crucify mankind upon a cross of gold." Basically saying that the government needed to be able to expand the money supply in order to assist these everyday American citizens. Now, inflation, on the other hand, happens when the money supply expands more quickly than the supply of goods and services, also known as the demand for money. So again, if you picture a supply and demand curve, imagine supply increasing, but demand stays the same, and the price goes down. In this case, the value of the money goes down. This is really common with fiat currencies, which again, we'll talk more about what that is and what that means. But as an example, during the height of the COVID pandemic, demand for some types of goods surged because people were home, they were unable to spend on services. And then stimulus checks gave people more money to spend. So we saw supply of a lot of goods decrease because of supply chain issues, while we also had an increase in demand. And then we also had an increased supply of money at the same time. And all of these things came together to lead to a huge spike in prices or inflation. So what is a fiat currency? We've used this term a few times now, so we want to make sure we define it. So fiat currencies are just currencies that are not backed by a particular commodity like gold. So the money cannot be exchanged for a certain amount of gold or anything else. Fiat currencies only have value because we agree and believe that they do. And their value is susceptible to expectations about the future, just like any other commodity like we talked about earlier. So because the money isn't backed by anything, it's extremely easy to print more. And this is encouraged by something called seigniorage. Seigniorage is just the difference between the face value of money and the cost to produce it. So, for example, a $100 bill only costs a few cents to produce. Because of this, the government is able to spend just a few cents to end up with $100, which they can then spend on whatever they want. So, when the government needs money, they can get it from either taxing their citizens or they can print it. Now, which do you think they're going to do? So the temptation to print excess money is very high, and it can lead to inflation. So how did we get here to a world where most currencies are fiat currencies? What happened to the gold standard? The US was on the gold standard up until World War II, but after World War II, trade and the global economy were growing rapidly, while the money supply was not. And we wanted to avoid deflation. So countries of the UN got together at a conference in Bretton Woods, New Hampshire in 1946. And they decided to make the US dollar the international reserve currency. And this meant that the US dollar would be backed by gold, but the rest of the world's currencies would be backed by a combination of gold and US dollars. Now, this benefited the US greatly because they could print money, spend it overseas, and that money would then go into bank vaults as backing currency, meaning we could print money without the same risk of inflation. So by 1965, there were more US dollars overseas than there was gold in the US reserves. This was not great in a system where the US promised all its currency would be backed by gold. So, if everyone in the world wanted to exchange their dollars for gold at the same time, the government would not have been able to do that. And remember, one of the things that makes the gold standard work, like we talked about earlier, is that people need to believe the government will be true to its word, will have the gold, and will honor the exchange. And in this scenario, it would have been impossible. So in 1971, Nixon announced that the US would no longer exchange dollars for gold. Despite that being the basis for the entire global economic system, and this is how the dollar became a fiat currency. It no longer had any intrinsic value and was not backed by anything at a fixed rate. This was the first time the world saw a system like this. People were quite worried at the time, but surprisingly, there were no major consequences really, and the world continued to operate by backing other currencies with dollars, as was agreed at Bretton Woods. The only difference was that the dollar was just no longer backed by anything itself. One concern that people have about fiat currencies versus gold has to do with stability. There was, and in some circles is, this idea that currency value is stable when it's tied to gold. But the value of gold has always been volatile itself, meaning that currency value was too. So you can see from this graph, this is the value of gold over time. It is very up and down, meaning that when currency was tied to gold, the value of the currency was as volatile as the value of gold. So a steady 2 to 3% yearly inflation for a fiat currency, which is what's targeted by the Federal Reserve, is much more stable over time than the value of gold has been. Now, I want to bring cryptocurrencies into the conversation here briefly, just to point out that in some ways, crypto operates similarly to gold in that the supply is somewhat limited. There are a maximum number of Bitcoin that can be mined. Once they've all been mined, that's all there will ever be. And this is often used as a selling point to demonstrate that it will hold its value. But you can imagine how if a country were to use a cryptocurrency like Bitcoin as their primary currency, they would likely run into the same issues that ended the gold standard, the inability to expand the money supply to keep up with demand. And just like any currency, though, its value is determined both by our belief in its value and our expectations of its future value. And we should also note here that there are extremely high computing costs to maintaining cryptocurrencies, much higher than simply replacing old paper bills in circulation. And so far, the only sustained use cases for crypto involve black market trading, bribery, ransomware, evasion of government regulations, etc. So, because fiat currencies aren't backed by anything, it gives the government a lot more control over the money supply and, by extension, inflation and deflation. So, how do they do that? One way is through printing money. The other is by setting interest rates, um, which impacts the velocity of money. And we'll talk more about that in a little bit. So, like we talked about earlier, a government-controlled inflation rate is more stable than the value of gold. But this assumes that the government does a good job at this, and they don't always. So, for example, at the end of World War I, Germany owed a lot of money to various countries as reparations for the war, and they printed a lot of money in order to pay those reparations, which led to hyperinflation. So, this photo here on the right is showing children standing next to a tower of German marks that was equivalent to only $1 at the time. Zimbabwe also dealt with a period of hyperinflation that led to the printing of a $100 trillion note, which you can see here in the upper left, which ironically is now worth $100 to $200 as a collector's item. But Zimbabwe actually stopped printing their own currency in 2009 due to this hyperinflation, and they now use other global currencies instead. Lastly, here in the US, some attribute the inflation spike to the large amounts of money that were sent out via stimulus payments during the COVID pandemic. So, the last key concept we need to talk about here is the difference between a nominal interest rate and a real interest rate. So, nominal interest rate just means the rate that's written on the contract. If you go right now to get a mortgage and you're offered a 7% interest rate, that is the nominal interest rate. A real interest rate is just the nominal interest rate minus inflation. So essentially, you're saying that if the value of this money has decreased, then the value of the money I'm paying you is actually less than the nominal interest rate. So as a result, the higher inflation is expected to be, the higher the nominal interest rate is going to be from the bank in order to make up that difference. So now that we understand this, we can get more into how the government can control the money supply through interest rates. The Federal Reserve controls the interest rate at which they will lend money to other banks, and that becomes the rate at which banks will lend to each other. And this impacts interest rates in the economy at large. So when interest rates are low, people have more incentive to borrow money, invest, and spend, which increases the velocity of money and therefore the money supply. And this leads to inflation. So when the Federal Reserve wants to increase the money supply in the US, they lower interest rates. When interest rates are high, there's an incentive to save and hoard money, which slows down the velocity of money, decreasing the money supply and causing deflation. So when inflation gets too high, the Federal Reserve is going to raise interest rates to decrease the money supply and slow inflation. And this is what we've seen in recent months with the inflation spike. Interest rates were raised extremely high. And as a result, inflation has now lowered to a more normal level, and interest rates have been lowered back down accordingly. Okay, so tying some of what we've been talking about together, let's go over some of the key points. So low interest rates stimulate the economy and they get people spending. However, low interest rates will also lead to inflation because they increase the money supply. It should be noted here, though, that governments with a lot of debt may want inflation because of what we talked about earlier. Inflation is good for people who have debt. It's easier to pay the debt back when its value has decreased. So even if inflation might not be desirable for everyday citizens, the government might have these competing interests because they may desire inflation for their own debt levels. Now, the Federal Reserve controls these interest rates and therefore has a lot of impact on inflation, is politically independent. And they have this dual mandate to control inflation and unemployment. The bad thing about this is that the Federal Reserve is not accountable to voters. It has a lot of power, and it's an undemocratic organization whose leaders don't have to answer to voters in elections. Now, at the same time, if we want low and stable inflation, a politically independent Federal Reserve is going to help maintain that stability. We know that economic growth is a consistent predictor of election results. So if politicians could trade inflation later for growth and low unemployment now to do better in their upcoming election, they would likely do so. So we don't necessarily want politicians in control of the Federal Reserve for that reason. Now, something a lot of people use to argue this point, that a politically independent Federal Reserve is important, is an event that happened under the Carter administration when Paul Volcker was the chairman of the Federal Reserve. And at that time, we had high hyperinflation and high unemployment. So remember, we talked earlier about how inflation and unemployment historically trended in opposite directions. So this was a case where both were high. And Paul Volcker decided that they needed to take care of inflation first and then address unemployment. So to do that, he raised interest rates quite high. And this did bring down inflation, but it also kept unemployment high, which made both him and Carter very unpopular at the time. But inflation did go down enough for the economy to start growing again, and unemployment went down as a result. And so it was ultimately seen as the right thing to do, but it was a really politically costly move. So if Volcker had been in an elected position, it's likely he would not have made the same choices. So let's review some of these key concepts before we wrap up and how they all connect to each other. So first, we talked about what money is, right? It's a medium of exchange, a unit of account, and a store of value. Then we talked about how we know what the value of that money is. And we know that the value is determined by supply and demand, just like anything else. So demand is determined by the amount of goods and services available for purchase, and the supply is determined by how much money is printed and the velocity of money. We talked about inflation and deflation. Inflation being a decrease in the value of money, and deflation being an increase in the value of money. And then lastly, we talked about how the Federal Reserve is able to manipulate some of these factors in order to have a semblance of control over the value of money. So when there are low interest rates, we have an increased incentive to borrow, invest, and spend. This leads to increased velocity of money and therefore an increased money supply, which then leads to inflation. Now, in response to inflation that is getting too high, the Fed will raise the interest rates. Now we have high interest rates, which leads to an increased incentive to save and hoard, which leads to deflation. And when the deflation gets too much, the Fed will then lower interest rates and the cycle will start over. So that concludes our lecture on what is money. Next, we'll start getting into exchange rates and the value of different currencies in relation to each other and how that works. Thanks so much for listening.